The reported acquisition of a waterfront mega mansion on Indian Creek Island in Miami by Mark Zuckerberg, with an estimated value between $150 million and $200 million, should not be viewed merely as another headline about billionaire real estate. Within the context of American real estate market analysis, transactions at this level function less as lifestyle statements and more as strategic indicators of capital positioning. When an ultra-high net worth individual allocates this magnitude of capital into a geographically constrained luxury enclave, the implications extend far beyond a single property and begin to reflect structural forces shaping the upper tier of the housing market. Indian Creek Island occupies a unique position within the South Florida real estate ecosystem. The island spans roughly 300 acres in Biscayne Bay and contains fewer than 40 residential estates. That finite number is not a temporary development limitation, it is a permanent structural constraint. Unlike high-density luxury corridors such as Brickell or Sunny Isles Beach, Indian Creek cannot expand vertically or horizontally in any meaningful way. There is no large-scale development pipeline waiting for regulatory approval, and there is no reserve of vacant parcels capable of materially increasing supply. In real estate economics, permanent supply caps create a fundamentally different pricing dynamic from markets where developers can respond to demand with new inventory. Since 2020, Miami-Dade County has experienced a measurable shift in luxury demand patterns. The period following the pandemic accelerated domestic migration trends, particularly among high-income households, relocating from states such as California and New York. During that time, transaction volume in the $10 million and above segment increased significantly, and properties exceeding $20 million began trading at a pace previously unseen in the region. As demand intensified, days on market compressed, and price per square foot reached record territory across multiple waterfront submarkets. In comparable ultra-luxury waterfront transactions across Miami-Dade, price per square foot in certain cases has exceeded $4,000, depending on lot size, privacy, dock access, and architectural quality. Indian Creek, given its security infrastructure and extreme scarcity, operates at the upper boundary of that pricing spectrum. When analyzing valuation in this segment, it is essential to recognize that the relevant benchmark is not median Miami pricing, but rather the global trophy asset category, where buyers evaluate properties relative to estates in Palm Beach, Malibu, the Hamptons, or even international luxury hubs. The broader migration context adds another layer of structural support to South Florida's high-end market. Between 2020 and 2023, Florida recorded one of the strongest net domestic migration inflows in the United States. Importantly, higher-income households were disproportionately represented in that migration flow. At the same time, California and New York experienced net outflows of affluent residents. While migration decisions are influenced by multiple variables, including lifestyle preferences and business expansion, tax structure remains a meaningful factor in high-net-worth planning. Florida's absence of a state income tax creates a measurable differential in long-term wealth retention compared with high-tax jurisdictions. From a real estate valuation standpoint, this tax differential affects purchasing power. If a buyer anticipates retaining a greater portion of annual income or capital gains by establishing residency in a no-income tax state, that buyer may rationally allocate a larger sum toward a primary residence. Over time, this dynamic can raise the ceiling for acceptable acquisition prices in tax-advantaged markets. Therefore, when evaluating a transaction potentially approaching $200 million, the analysis should consider not only comparable sales, but also the fiscal environment that influences buyer behavior. The debate in California surrounding a proposed wealth tax, even if ultimately unsuccessful, introduces an element of policy uncertainty that real estate markets must factor into forward-looking analysis. Real estate does not respond solely to enacted legislation. It responds to anticipated risk. When high-net-worth individuals perceive even a possibility of structural tax shifts, long-term domicile planning often begins well before final policy decisions are made. Property acquisition frequently represents the first visible stage in that planning process. It is important to clarify that purchasing a residence in Florida does not automatically establish tax residency. Legal domicile requires satisfying specific criteria related to physical presence, voter registration, driver licensing, and other statutory factors. However, from a market perspective, initial acquisitions by ultra-high net worth individuals create incremental demand in a segment where supply is fixed. If similar buyers follow comparable strategies, cumulative demand pressure can lift price floors in enclaves such as Indian Creek. Comparing Miami's ultra-luxury market with coastal California markets reveals structural differences that extend beyond taxation. California luxury markets benefit from deeply entrenched technology wealth, established cultural prestige, and historically strong international buyer pools. However, they also operate within regulatory frameworks that can constrain development timelines and increase transaction complexity. In contrast, Florida's regulatory posture has generally been more development-oriented, particularly in high-growth corridors. While Indian Creek itself is not a development-driven market, the surrounding South Florida ecosystem benefits from comparatively flexible zoning and permitting processes. Another relevant factor is risk perception tied to geography. Coastal California markets face ongoing considerations related to wildfire exposure and insurance volatility. Although Florida carries its own climate-related risks, including hurricane exposure, the insurance landscape and mitigation strategies differ structurally. For ultra-high net worth buyers who diversify property holdings across multiple states, relative risk calculations become part of portfolio strategy. In that context, acquiring a trophy property in South Florida may represent geographic diversification rather than wholesale relocation. When assessing whether current pricing levels indicate speculative overheating, it is necessary to distinguish between vertically built luxury inventory and horizontally constrained estate markets. High-rise luxury condominiums can be oversupplied during aggressive development cycles, leading to price corrections when absorption slows. Indian Creek, by contrast, operates within a micro-market characterized by infrequent transactions, substantial land parcels, and predominantly low-leverage ownership structures. Ultra-high net worth buyers in this tier often deploy significant equity, reducing the probability of distressed sales during macroeconomic downturns. Lower leverage tends to dampen volatility and preserve long-term pricing stability. Prestige clustering also plays a measurable role in valuation dynamics at the very top of the market. When multiple globally recognized billionaires establish residences within the same enclave, the location accrues signaling value. In luxury real estate, signaling can translate directly into pricing power because social proximity and peer concentration enhance perceived exclusivity. This effect is not easily replicated by newly developed communities, regardless of architectural quality. Over time, enclaves that achieve critical mass among ultra-high net worth residents tend to command sustained premiums relative to broader regional averages. If the reported acquisition by Zuckerberg closes near the upper end of the estimated range, it may establish a new benchmark for waterfront estates in Miami-Dade County. Benchmark transactions in ultra-luxury markets often have a cascading effect, influencing seller expectations not only within the immediate enclave, but also in adjacent high-end neighborhoods. Areas such as Bay Point, Star Island, and select Palm Beach waterfront zones may recalibrate pricing strategies in response to new top-tier comps. This tiered repricing mechanism can gradually elevate the broader luxury spectrum. For investors and developers observing these signals, the critical distinction lies between replicable and non-replicable assets. While developers can construct new waterfront estates along certain Miami corridors, they cannot create another Indian Creek Island with fewer than 40 parcels and a permanently controlled access point. True scarcity assets operate under a different valuation logic than speculative luxury builds. Long-term appreciation in such enclaves is often tied to land scarcity rather than construction cost escalation. In evaluating whether Miami's ultra-luxury segment is transitioning from cyclical growth to structural dominance, analysts must monitor continued migration patterns among ultra-high net worth households. If net inflows of affluent residents persist over the next 5 to 10 years, demand for permanently constrained waterfront estates may remain elevated even during broader housing slowdowns. Conversely, if migration normalizes and fiscal uncertainty subsides, transaction velocity at the highest price tiers could moderate without necessarily triggering significant price declines, given the low leverage ownership base. Ultimately, the significance of a transaction potentially valued between $150 million and $200 million lies not in its headline appeal, but in what it reveals about capital allocation preferences. Real estate at this level functions as both residence and store of value. When capital of this magnitude selects a geography characterized by tax efficiency, supply constraint, and prestige clustering, it signals confidence in the long-term positioning of that market. From a purely analytical standpoint, the reported purchase should be interpreted as part of a broader pattern in which American wealth is reassessing geographic alignment. Whether or not this individual formally changes residency is less important than the measurable increase in demand for South Florida's most exclusive inventory. In markets where supply cannot expand and ownership is concentrated among financially resilient buyers, incremental demand shifts can have outsized pricing effects over time. If current trends persist, Miami's ultra-luxury sector may continue solidifying its role as a primary destination for high-net-worth capital within the United States. For market participants, the key variables to monitor include transaction volume above $20 million, price per square foot progression in trophy waterfront segments, and ongoing migration data from high-tax states. These indicators will reveal whether recent headline acquisitions represent isolated events or the continuation of a structural rebalancing within the American luxury housing market.